A love-hate relationship. Joining us from the Flora CME Group, Alan Nuckman and Scott Gelady. They love this segment, but they hate to be wrong. Good to have you on the show this morning, guys. Let's get you going to topic number one. Guru gains. Warren Buffett made $1 million bet against hedge funds. Is it better to follow Buffett, hedge fund money, or just jump into the S&P 500 and hope for the best?
It depends on your time frame. If you've got unlimited money and unlimited time frame, you could do what Warren Buffett does and just be positioned for the long term and wait for the markets to eventually climb higher. Otherwise, there's a timing factor involved for the rest of us mortals.
It's called the modern portfolio theory of money management. Generally, it's a 20-year time horizon. This is a little bit different because it's 10. But given 20 years, it's been mathematically proven that you just can't pick them. It's better to be in the S&P if you have that time. If you only have a time,
but are we going to live 20 years? That's the question.
I will. And if you keep this up, you won't.
Topic number two, bring home the bacon. Sales of the Bacon Bowl are sizzling. So how do you make a profit on this?
Wearing a cow jacket, which is not bacon, obviously, and having a family farm and a father that worked for Cargill.
You're an expert.
You can look for some of the publicly traded companies, but if you happen to know a Cargill, I think that would be something I'd rather invest in than the other ones that we've talked about
Smithfield
earlier.
got taken off. You know, we've got Hormel. Oscar Mayer is part of Kraft, and I think that has some more potential looking at it from the trading standpoint. From a technical standpoint, you could see a 50%. If you lean on 50, you could see a nice healthy move in Kraft. They've got a lot of brands, but bacon, they don't even trade it in the pits anymore, so you can't just singularly target bacon. And I was looking at one company, they make smart bacon, which is not even really bacon. So it's hard to figure this one out.
Topic number three, I'm loving it. McDonald's is going romantic this year by offering a Valentine's experience that includes waiters and candles on the table, maybe even some flowers. Would you buy the stock?
You know, I would. Number one, because I think that
Can we go
the
on a date?
economy is not doing very well, and McDonald's will outperform in a down economy. But number two is that if this McDonald's does have a McPlayland, I think Alan would be very interested.
McDonald's went from the lows in last year at 84 to the highs last year of 104. So 94 is the midpoint. We're at 95 right now. You can really lean on this level. Look for McDonald's to recover. It's still negative on 2014, and it's not like McDonald's is going out of business anytime soon.
Let's take a look at your bonus round question. It has to do with Valentine's Day. We're looking at tickers to love. Which one is the fake ticker? R-O-S-E, Rose, T-I-F, TIFF, HSY, FLWS, and WINE.
They're all real. They're all real this time. Yeah.
Just because I'm standing next to Alan, I'll pick WINE.
That would be W-H-I-N-E.
But they don't. It's too much for the ticker. So
Exactly. The answer is wine. We made it up, and I knew you were going to whine about this. So thank you, Scott.
all righty.
Love
Thank
you
you.
guys. Happy Valentine's Day. First
See ya.
Business continues right after this.